It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the show. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Tax planning should be a focus of your comprehensive financial plan. And this year, there are even more issues that you need to be aware of due to the CARES Act and other stimulus plans. That's why today we're going to help you understand and identify what are the tax planning tips you should be taking advantage of on today's episode.
That's right. And I would say issues might be the wrong word. These are opportunities. This is stinking unbelievable. If you're a geek like us, and tax laws keep changing and they keep presenting opportunities if you take them up. So we're going to help you with that today. If you have any questions, we'd love to hear from you. You can engage with the show in a couple different ways. Call or text your question to us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. There's a whole bunch of information right there. You can submit questions there on the right. And then all over social media, wherever you're at, we're there too. Search the Wise Money Show, follow us there, and you can submit questions there as well. So, like Josh said, tax planning is a core focus of comprehensive financial planning. Every financial decision you make has some sort of tax impact, even if it's just buying a coffee. That's money that could have gone into an IRA or Roth IRA. I'm not saying that you shouldn't enjoy that coffee, because I certainly do. But anyway, every decision you make has tax consequences. And you really should have one objective, and that should be to pay the least amount of tax over your lifetime. And now with the Secure Act, it's multiple lifetimes, multiple generations. So that's the job of your CFP and the ones that are doing comprehensive financial planning. So with the CARES Act, not the Secure Act, with the CARES Act, the rules all changed again and created a whole bunch of tax law changes, but tax opportunities. And we're going to talk about them today. The first one, the coronavirus-related distribution. It's a mouthful. What's that all about?
Yeah, it didn't even exist until this past spring, right? So it's an opportunity kind of to take advantage of this new category of distributions if you're a qualifying individual, which of course the IRS always takes time to define exactly what that is. It's someone, are you a COVID patient yourself? Have you been tested positive? Mm-hmm. Or your spouse or a dependent? And then they get into a little bit more vague area that really broadens the definition. Have you had adverse financial consequences from either being furloughed or laid off, quarantined, that sort of thing? So a lot of people this applies to, but it gives you the chance to take money out of your retirement plans and avoid the 10% penalty that normally applies if you're under age 59 and a half. And it's a big dollar amount that you can pull out and qualify for this. It's up to $100,000 if you do it this year.
There's one other big advantage, and it's not just, you can avoid the 10% early withdrawal penalty. You can also spread the tax over 3 years. So if you're looking at your tax situation this year and say, well, geez, I need to get my hands on $100,000, but I don't want to pay tax on $100,000 this year. Well, geez, if you've gotten COVID-19, actually, if your spouse has gotten COVID-19, then you can do it.
Yeah, you don't have to justify the dollar amount that you pull out either.
That's right. And then lastly, this is another just unprecedented tax strategy. If you then say, I really didn't need this money, you can put it all back. Normally, you've heard of a 60-day rollover. This is I'm not even going to get into it and do the math on how many days. You had 3 years to decide if you want to put the money back. And even if you already took the money out and you got to claim a third of it on this year's return, a third next year's return, and then you're into 2022 and you're like, I didn't need this money. I'm going to give it all back. You can amend your 2020 return, amend your 2021 return, and then not claim it on 2022. Crazy. It's crazy.
It's relatively simple too.
Yeah, I'm sure TurboTax will have that all figured out for you.
I love that. So I was thinking about this as we were preparing for the show, and I thought, okay, what's the question you would ask yourself right now? And the question is, do I have a plan for how I'm going to pay my taxes today and for the rest of my life?
I thought you were going to say the question should be, what in the world are these guys talking about? What are these guys saying? This doesn't make any sense.
It doesn't make any sense. And that's part of a financial planner's job. When I say financial planner, it's kind of confusing because most people think, oh, it's just an investment girl or an investment guy. No way. Financial planning is a science, and tax planning, I believe, is one of the most important areas. So if you said, hey, I'm going to a financial planner to get help, what I would want to hear is, and they're helping me with my tax plan. Because if they're just selling you investments, they're not really helping you. You need a tax plan, especially for 2020. It seems like in 2020, there are kind of the winners and the losers, and it doesn't seem like there's anything in between.
Yeah.
So for instance, if I owned a theater and Hollywood's not putting out product and I don't have new product to run through my theater, I'm dealing with something that no one could have ever imagined. But if I'm selling lawnmowers or there's a lot of other
bicycles
things,
and
lumber that's up 137%.
Or I build houses, right?
Right. So then there are some folks that are so busy they can't keep up. So it's almost like the winners and the losers, and there's not any in between.
Exactly. There's either panic buying of everything, or there's like destitute. I mean, it's crazy.
Yeah.
Well, I'm glad that you're pointing to tax planning as a piece of the overall financial game plan that people should be building with their CFP. If there was ever a year to be proactive and looking out not just to how's your 2020 tax return going to shake out for this year, but now you need to actually be thinking 3 years down the road. Mm-hmm. And that's difficult to get your mind wrapped around sometimes because you don't necessarily know exactly what the tax laws are going to be in the future. We believe we do. They're set for that period of time, but they could be repealed. They could be changed. A lot of it just depends on how things shake out politically. But to me, you have to have your game plan in place for what makes sense in your life based on what you know today. And that's really the process that a certified financial planner takes you through as they're building tax planning into your overall financial plan.
Okay, so a couple more things with the coronavirus-related distribution. So this is an aggregate amount. You can take up to $100,000, but don't think of this as, well, I've got 4 IRAs, so that means I can take $400,000. No, it's an aggregate amount. You can also do a coronavirus-related distribution from a 403b, 401k, and again, it's aggregate.
And a simple IRA.
Yeah.
Mm-hmm. And the 2-year penalty is waived for a simple IRA.
So here's the thing, and Josh, you sort of mentioned it, but it's worth pointing out. How do you do this? Is there a special form coronavirus-related distribution? Is there a special thing that I need to communicate to Fidelity or to my financial advisor when I do this? No, it's something special you do when you file your taxes. And so if you're still filing your taxes by hand, pencil and paper, that still happens. You might miss this. If you're doing TurboTax or Tax Slayer, which is hilarious, by the way, or whatever, right? You might miss this. And if you're going to just a neighborhood CPA, not a CPA, neighborhood tax preparer who does taxes out of their house, you might not catch this stuff. Easily missed. Could you imagine? I took $100,000 out. It all lands on my return, and I have to pay tax on all of it. Oh, that was supposed to be spread out over 3 years. Whoops. That's a big, big difference. Make sure you're doing comprehensive financial planning and working with a team of professionals to get your return done correctly. There's a lot more to hit here with different CARES Act tax strategies, so we've got that and more coming up on The Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is The Wise Money Show. You're at The Wise Money Show channel. Make sure you hit that subscribe button. If you're not a subscriber, turn on notifications as well so you're made aware every time we drop new content. And if you like the content, give us a thumbs up. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel. I get some comments every once in a while, not often, that say, oh, you didn't need 50 minutes to talk about that. And it's a talk show. Actually, yes, that's what we do. We break it down into pieces. If you don't like the length of it, every single business day, we drop a smaller nugget of financial wisdom, a next wise step video. So make sure you check that out as well. Hit that subscribe button, turn on notifications, leave comments below as well. Thank you very much.
So I think we probably should hit the how are the taxes paid? Do I have an option to pay a third, or can I pay a nothing, 100%? Because and I think...
Do you have experience with that? The only ones that I've done, people have not withheld any taxes.
Right. Well, that's the thing, that the mandatory 20% withholding
Correct.
is not not mandatory.
Right. So how is it if you take 100 out and say withhold 12%? Is it fractionally? I'm assuming it's fractionally split up, right? They're not withholding that full 12. So if you take 100, 12 grand isn't going to be withheld for the first year and then nothing for the next two. It would be proportionate, right?
Oh, nice question, Grass.
I know. I've done 2 of these with folks, and they both have said 0% withholding.
Yeah, I think to me it seems like the key is for people to understand this is something you can do, and to be reminded that just because you can doesn't necessarily mean you should. And this is not only part of your tax plan, it's part of your retirement plan.
And here's the message though. I think if you've had COVID, if your spouse has had COVID, you've been financially impacted, and you think this might be an idea you should consider, you've got to talk to your certified financial planner.
For sure.
I mean, that's it. So I think that is the overall message, as opposed to going through all of the little details.
Yeah, I'd say talk to your financial planner after you've recovered.
Yes. Or do a Zoom meeting.
No, not while you're symptomatic, please.
That's right. All right.
All right.
Does getting the coronavirus open up new tax opportunities for you? Believe it or not, in this bizarro upside-down world, that answer is actually yes. We're talking about that right now and other tax strategies. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard, here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show, follow us there, and leave questions there as well. All right, we're wrapping up the coronavirus-related distribution before we talk about some other tax strategies that are new for this year, once in a lifetime, 2020 only. But a couple more comments here on the coronavirus-related distribution. I mean, the big message is, if you've had COVID-19, I heard a joke today. Someone said, I was just diagnosed with, get this, COVID-16. Oh, I'm so embarrassed. I thought that was pretty funny. I mean, how do we go from COVID-19 to COVID-21 or 22? Where do we go from here? I don't know. Anyway, so if you've been diagnosed, or your spouse has, or you've been financially adversely impacted by shutdowns or layoffs or furloughs, you've got an opportunity to take a coronavirus-related distribution. And if you think you should, contact your CFP, because there's lots of details. You got to figure out withholdings. You got to figure out whether you'd want to pay it all back or whatever. And usually, you're not geeky enough to do a multi-year tax projection. And your CFP, trust me, they are that geeky. They are.
Yeah, and I think I think of a couple things here, Mike. I think about, number one, how does this affect my retirement plan? Not just my tax plan, but what does this do to my retirement plan? And some of the folks that I'm thinking about are in a situation, and I've met with a few of these recently, where they panicked and sold back when the market was lower. And they can't believe that the market has come back and has kind of kissed these all-time highs. And it's like, only in a year of the coronavirus would you see this crazy thing. So they're saying, well, I don't even know what I should do. Should I pull this money out? Should I pull this money out and get into a different investment strategy, a different type of whatever? And they're kind of feeling like they're at the casino and they're down, and so they need to figure out a way to double down.
Yeah, right.
And I would say doubling down is not a strategy. Swinging for the fence and having to hit a home run is not a strategy. So I would say, all right, go and get help with someone who can say, hey, we can build a 3-year tax plan to figure this out if you're going to do one of these. And again, it has to be done by the end of the year. But I would really encourage you to make sure you're seeking professional help. It is amazing the relief that comes over someone as you're explaining to them what their options are and how you can make chicken soup out of.
Yeah.
You know, what we're talking about here is the tax flexibility that exists this year for those who need to pull money out of their retirement accounts due to coronavirus implications of some kind. And I think we should also not lose sight of the fact that, yeah, you're dipping into long-term assets to deal with short-term needs, and that has consequences as well. So maybe there is some flexibility, and yes, we're using the word opportunity here to plan your taxes better, but don't lose sight of the long-term implications for your retirement outlook as well.
And what I've seen, and I don't know if you guys listen, one of my favorite things to listen to on a daily basis is something called the Wise Money Minute by the host of the Wise Money Show, Michael Paul Bernard. And it's very educational, and I learn something almost every day. And I learned that they're going to be assessing, if you're doing a refinance, they're going to be assessing a charge. So that reminded me when you said I'm using long-term dollars to solve short-term problems. I've seen a number of folks that have used this opportunity to refinance to go from a 4% 30-year to a 15-year 2.5% mortgage. And some of them, the rate would be bumped a little bit, but some of them have done a cash-out refi to clean up their balance sheet. Now, if you do a cash-out refi to clean up your balance sheet and you're just dealing with symptoms, but you haven't taken care of the underlying problem, that is a horrible idea.
Yeah. Mm-hmm.
But if you have a strategy and you have a budget and you have the basic disciplines in place and you have a coach, then I would say, go for that. Use short-term dollars or lazy dollars or cheap dollars to solve your problem.
Man, I feel like we could spend this whole show talking about the interconnectedness of decisions you make in one area of your life in other areas of your financial plan as well. And, we've mentioned your retirement picture, your investment picture, maybe your balance sheet or your debt structure, that sort of thing. Don't lose sight also, for those of you, if you're pulling money out of retirement accounts because you lost your job or some sort of hardship, and now maybe you're having a restructuring of your health insurance, and maybe you're going on the Affordable Care Act or an Obamacare plan, as they're sometimes called. When you pull money out of these retirement accounts, you're changing the calculation of what your income picture looks like, and maybe changing the financial or the economic cost to you of that health insurance plan. There's so many moving parts when you're making these decisions, and that's why, you just keep hearing us say over and over, it's got to be a decision that you make in the context of an overall financial plan.
Yeah, absolutely. And that got me thinking of one other thing. Now, this isn't unique to right now, but what is unique is the 25 million people that are on some sort of unemployment and the record amounts of people that have been furloughed or laid off. And if you need to clean up your balance sheet, and one of the strategies you used in the past was a 401k loan, and you still have a 401k loan on your 401k, but you're no longer at that job, you've been furloughed, or maybe that's turned into a permanent layoff, and you think, all right, well, I'm going to roll that account over. I'm going to roll my 401k over to my IRA. That loan gets counted as a distribution. And does that loan have these nice fancy treatments of this coronavirus-related distribution? No, it does not, folks. So you got to work with your certified financial planner. It's almost like, and I've told this story before, but when the CARES Act, which is what we're talking about here, when the CARES Act was announced, we huddled up, I think the very next day, and we listened to a 2-hour breakdown of all the intricacies of this by a research group. And I remember my head just spinning at 6 o'clock on a Friday night when it was over. And I'm sitting around these tables with our CFP team. And I said, oh my, what in the world did we just do? What did we just do? These rules are crazy. And then it dawned on me. People need us now more than ever. People need comprehensive financial planning now more than ever. The financial advisor, in air quotes, that just helps you with mutual funds is going to be obsolete. They no longer can help you because the world has just changed. You can't make that investment decision without knowing what the tax strategies are and tax implications are.
You can. We see it because we see it, and you ask the person, so when's the last time your investment seller talked to your tax preparer? And like, well, they never talk. But I was surprised at how much I owed in taxes. I'm like, well, of course you're going to be surprised because if they're not working in conjunction with each other and they're not collaborating, you're going to have a bad result because your investment seller is going to say, hey, listen, we're going to do this stuff because it seems to make sense from an investment standpoint, and consult your tax advisor.
And I think even more so, you're going to miss out on some tax opportunities that had existed you didn't even know about, you weren't even aware of. We're just scratching the surface. There's a ton more baked into the CARES Act. We're going to hit them for you. That and more coming up here on the Wise Money Show with Korhorn Financial Group. All right, guys, we're pulling a quick audible here. I have not mentioned the extra sponsor, and we are through one segment, but we're actually through two. We're not doing that sponsor in today's show. We're going to do it for next show.
Yeah.
And we're going to keep going here. So let's do the RMD stuff in the third segment, and then this sort of popcorn of these other strategies can be in the fourth segment, which will sort of feel like some additional variety. But let's hit RMD right now.
Did you say popcorn or corn pop?
Corn
Corn pop.
Cornhorn.
Corn pop. He was a real bad dude.
I don't know what that was.
It's a reference to current events. Hey, Josh, did you know there was a hurricane in Louisiana?
No.
Okay. Happened in 2005. Just wanted you to know.
Okay, thanks.
All right.
Check your Slack.
Corn pop.
I don't know it. We've been talking about tax flexibility that is unique to this year. And I tell you, this next opportunity within the CARES Act that we're going to talk about is my favorite of all of them. We're going to hit that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFC studios, Kevin Korhorn and Josh Gregory in... Oh, my goodness. You guys are just...
Come on, just bring it, Mike.
Okay, all right.
We're having fun over here.
All right. Every episode...
Don't lose your military bearing here, Mike.
Every episode of the Wise Money Show, if you've missed anything, is on the YouTube channel. And you might want to check out the YouTube channel just to see the antics that Josh and Kevin are up to right now, trying to distract me while I'm talking. But head over to YouTube, search the Wise Money Show, subscribe to it. If you like the content, give us that thumbs up. We appreciate that. So, all right. So here we go. Lots of tax laws changed with the CARES Act. They're sort of once a year or like one-time opportunities. And in my opinion, none bigger than the RMD holiday, required minimum distribution holiday. Now, just to set the stage for this makes absolutely no sense. At a time when we said we've got to spend a bunch of money to help the economy recover, at a time where they created unprecedented new rules for you to get access to your retirement accounts via the coronavirus-related distributions and changes with 401k, loan amounts, all that sort of stuff, so that you could have access and get access so you could spend more money. They then said, oh, for those of you that are forced to draw money out, nah, you don't need to do that. That makes no sense, but I'll take it. If you were supposed to take, if you're supposed to take a required minimum distribution every year from your IRA, from your retirement account this year, you don't have to.
Yeah, so you're talking about folks who are over age 72 this year, if you're required to pull money out, and those who have inherited a retirement plan from maybe a family member who had already started drawing their own plans, and you have to continue it for them, essentially.
Or just inherited it, period.
Yeah,
right.
That's right. So hopefully if this applies to you. Hopefully this is part of your annual tax planning every year, knowing that you've got to get the right amount out, but you get a year of reprieve. And I don't know. I've encountered a lot of people that, we tell them that they get a year off and don't have to pull it. But what if you're just living off of those retirement accounts and you just need the money to make ends meet? There's a lot of folks who maybe they see this opportunity and it just doesn't really apply to them, though.
Sure there are. And the one thing that you can't do with your required minimum distribution, so if I have to take a $10,000 required minimum distribution because I'm 72 or older, which that changed this year, which is don't get me started. It used to be 70 and a half. That's the age everyone knew. And there's some great reasoning why we moved it to 72. So at 72, you have to take a required minimum distribution unless it's the year 2020 with the coronavirus, then you don't have to. But if my required minimum distribution amount was $10,000, what I can't do with that $10,000 is take it out and convert it to a Roth IRA in a normal year.
Yeah.
But this year, I actually could convert it to a Roth IRA. Now, the Roth IRA is beautiful. It's a 24-karat gold Cadillac. It grows tax-free forever. There's all kinds of great features and benefits of a Roth IRA. So this might be the year from a planning perspective that instead of taking, because you say, hey, I don't have to take my required minimum distribution. And I would encourage you, if your parents are including you on their financial life, and you're looking at their tax return, if they're married, they're in the 12% tax bracket up to about $80,000. And if they're single or widowed or widower or whatever, they're at about $40,000 in the 12% tax bracket. It might make sense on those dollars to have mom and dad pay taxes at a lower rate, especially if you're in Michigan. Because if I pay taxes federally on the lower rate, but I don't pay state taxes, guess what? My beneficiaries will likely pay higher federal taxes and state taxes.
Yep.
So there's some amazing tax planning opportunities that you want to help your folks with, because the folks are coming in to see us, and you look at their tax return, and they had $990 of taxable income last year. So that's 10% money. So they paid $90 of federal tax.
It feels like a win.
Yeah, it feels like a win until you realize that you've missed an incredible opportunity for years.
Right.
So if you're helping mom and dad at all with your finances, and we have the 70-40 rule, which is by the time you're 70 or by the time your kids are 40, there should be some great communication within the family about mom and dad's finances. Sometimes that's hard to do, and so make sure your certified financial planner is helping facilitate that. But if you're an adult child helping your parents, I'd say take a peek at that tax return and zero in on the taxable income number.
Yeah, because it goes back, I don't even remember which of you said this earlier in the show, that the wins should be defined when you look at multiple generations or at least multiple years. And so, looking at a tax return and realizing that mom or dad paid zero tax when really they could have maybe taken money out of their retirement accounts and either still paid zero or paid 10 or 12%, that might be avoiding a much worse tax paying down the road if any of those dollars are ultimately left to you as an inheritance and you pay tax at a much higher rate potentially. So we want to look and think multi-generationally when you're making your tax decisions.
And you got to do it in a way that you don't sound greedy. If you're bringing this up to mom and dad, like I guess there's I would just ask, hey, mom and dad, did you take your required minimum distribution this year? And if they said, yep, we took it there, then you got to say, was that?
I'm sure they sound like that.
That's what you're going to sound like when you're 85.
So then there's your opportunity to say, wait a second, you actually didn't have to. So then here's the question. Well, they passed this thing at the end of March. I already took it. Can I undo it? And the answer then lies in that coronavirus-related distribution. I mean, technically, there are some unique rules this year where instead of just a 60-day window to put that money back, you've got longer than that. So there might be a way, if you're listening to this saying, what? Or you have that conversation with mom and dad and they already took it and you're like, well, we wanted to do something different with that. There's a way to undo it. What if you already inherited mom and dad's account and you already took your required distribution as a beneficiary? There's no way to undo that, unfortunately. Seems unfair in my opinion, but life's not fair.
At all.
And they didn't ask me.
Corn Pop was a bad dude.
So the other thing that I would consider is I had this incident just happen yesterday. So folks came in and they had already taken the required distribution. Get this, we met on the 26th of March, and this thing was passed on the 27th. So we took it out already, but they're planning on doing some home projects. And so they're like, well, do we undo this? And we did a tax projection, and I said, you're going to be right at the top of the 12% tax bracket. We are not undoing this. Mm-hmm. Keep that money. Keep it in the bank for next year's house projects, because I'd much rather have you pay tax at 12% than have you leave that money in and take extra money out next year and put you in the 22% tax bracket. So just because I guess the point is, if you need the money because you're living off of it, well, this really doesn't apply to you. You got to draw the money out anyway for your lifestyle. If you don't need the money, there's an opportunity for you to just pass. There's an opportunity for you to do a Roth conversion. There's an opportunity for you to just still take the amount out anyway, or a lesser amount or whatever. Talk to your certified financial planner who's doing tax planning with you. We've got, believe it or not, even more new tax strategies to talk about right now coming up on the Wise Money Show with Korhorn Financial Group. Oh, my goodness.
So here's what you know.
Corn Pop was a bad man.
No, a bad dude.
Bad dude.
And he ran with a group of bad boys. So I think as the official current events coordinator here at KFG, these videos should be mandatory. Like you can't not listen to this stuff and somehow in some way, shape, or form act like you know what's going on in the world.
That was the same video clip where he talks about the hair on his legs. Yeah. Now I've seen that.
Yeah.
Anyway,
sleepy. Okay,
let's get into it. Fourth segment, land and plane. 13 minutes. We got lots to talk about. All right. The tax rules have completely changed for this year. I'm not talking about the Secure Act. I'm talking about the CARES Act. We're helping you with those opportunities coming up right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. If you love listening to podcasts and you like this show, every episode of the Wise Money Show is on podcast, wherever you listen to, Spotify, iTunes. That's where I check it out. So go there, search Wise Money Show with Korhorn Financial Group, subscribe to it, and do me a favor, rate the show as well. That helps us, helps others find us as well. Okay, so here we go. We've talked about coronavirus-related distribution. We've talked about the RMD holiday. There's several other changes, tax law changes, baked into the CARES Act. The next one, there's two big changes related to charitable contributions, charitable deductions for 2020.
Yeah, you remember when the Trump tax laws got pushed through, and all of a sudden people were receiving these really high standard deductions. So less and less people, very few people are even able to itemize their deductions. And that matters because that's where you would typically in the past write off or take a deduction for the contributions you give to charities and whatnot. So all of a sudden, a lot of people who used to get some tax benefits for their charitable gifts no longer were. And so now they've actually introduced a $300 per spouse or per individual tax payer write-off that goes right on the front page of the tax return. and is no longer subject. You don't have to clear this high threshold with your itemized deductions in order to be able to get the benefit of this. It's just right there on the front page. So for a married couple, that could be $600 worth of your charitable giving that you get back essentially on your tax return as a deduction.
And a couple rules with this thing. And number one, you can't itemize. So you can't get a double deduction. So if you're already itemizing, then you're going to claim all your charitable deductions on your itemized deduction called Schedule A. Blah. The other thing is my understanding, guys, and correct me if I'm wrong, because I think I've said this wrong before. I believe these are cash donations. I don't think you can just drop a sweater off at Goodwill and say that thing was worth $600 and get that write off. I think it's got to be a cash donation. Does that sound right to you guys?
That sounds right, but I wouldn't.
I'm looking right here
at
at the IRS website, and it's not saying that. Not that I can see it, but I've heard that in order to be eligible for this new $300 per spouse or $600 for married filing jointly, it's got to be cash contributions. And then as always, these charitable contributions, in order for them to help on your tax return, you've got to do them this calendar year. So you can't go to file your taxes next February and you're pulling up TurboTax and they ask, did you make a charitable contribution because you could be eligible for this, and say, oh, I didn't, but I'll do that now. No, you can't. You got to get it done this year.
And for sure, if you live in the state of Indiana, you should be, if it's at all possible, doing a charitable contribution because of the benefits on your state tax return of doing that. Is it $200?
Specifically to a college or university in Indiana, is that what you're referring to? Yeah. So first $200 per spouse gets you 50% of that money back in the form of a credit. So that's even better than these deductions we've been talking about. But that's all on your state, Indiana state tax return.
And you know what's interesting? This $300 or $600 deduction is something called it's an above the line deduction. I wonder if it's going to be an add back to states. So on Indiana, and I don't know this yet, folks. On Indiana, could you get a deduction?
There?
Could you get a deduction and then also get this tax credit because you gave the money to Bethel?
This is so
Wild.
horrible.
That's wild.
I know it is. The tax code just keeps getting more and more and more and more complicated. Mm-hmm. The last tax, the Trump tax cuts, as they call them, they said, hey, we're going to simplify. All that's happened is complication.
That's right. There's another charitable contribution change this year. It's not going to apply to a lot of folks, but it's going to apply to some. I know we're doing some planning off of it. And that is, there's usually a charitable deduction cap that you get. That basically, if you sell a business or you're very charitably inclined or something, and you make a big donation. Think church is doing a building campaign or something like that, and you make a large contribution in a year where your income isn't that big, you're actually capped on how much of that donation you are allowed to write off on this year's taxes. And don't worry, the amount that you don't get to write off carries forward into the future, but that influences your tax planning for sure. Well, they've raised that cap. It's now 100% of your adjusted gross income, so you can donate up to 100% of your income and pay zero tax. Now, I don't think you should. I don't think you should. I would get it to the point where you're paying only 10 or 12% tax, but you could. Interestingly enough, this raised limit, this increased limit, does not apply to contributions to a donor-advised fund. Why in the world? I have no idea. Just to make it more complicated.
Yeah.
So if you are someone that plan on making an unusually large gift this year, or this might apply, stop listening and just call your certified financial planner who's doing comprehensive planning and working with the CPA. They'll help you figure this out and strategize for it. So.
And if you did that, just if we're taking it a step further, if I zeroed out my federal tax bill, I'd still owe state tax.
Yeah, that's right. That's right.
So be aware of that, because there's another tax trap that goes along with it, which we were going to talk about at some point too, which is unemployment tax.
Well, let's get there right now. So, I mean, one of the other unprecedented things in the CARES Act was this thing called pandemic unemployment assistance, which is it's sort of two things. It's, hey, I'm a freelancer or I'm a contractor and I've never paid into unemployment ever, but I get to collect it. Interesting. Or I'm an employee and I have been paying into, or my employer's been paying into unemployment, and I get an extra $600 a week on top of my normal unemployment, and then it got extended and only an additional, I said only, I shouldn't have said only, $300 a week. Is all of that stuff taxable?
Yes.
Yes, it is.
Yes, it is. And you want to know that because a lot of folks don't realize that. There was a survey done, and 37% didn't know unemployment compensation is taxable income. Now, it's taxable income, but it's not earned income. So you're not going to pay self-employment tax on that, but you are going to pay federal and state tax on that.
The 37% of you, by the way, that didn't know that doesn't make you dumb. That actually makes you smart, because thinking that money that you're receiving from the government, you've got to claim as taxable income and pay some of it back to the government, that is the stupid part. That is dumb.
Well, there was a lot of dumb stuff that happened in 1986, the year I graduated. But that's when that law was changed. And they said, no, here, this assistance that we're giving you, we're going to have you pay tax on that. And so if you're not prepared for that, that could be a surprise, which, again, as we encourage people, hey, have a tax plan. Know what you should be expecting next April, but know it now so that you can be planning, and that if there's a surprise, get surprised in October or November of this year. Don't get surprised in April.
You know, the people who really get surprised are the ones where one spouse is receiving the unemployment, but the other one is just working as normal. So, you know, they're not in a much lower tax bracket potentially, but all that income could really have a decent bite out of it when you file your taxes. And if you haven't been prepaying that along the way, or setting aside some dollars so that you can, you know, make up for it at tax time, man, that creates a hardship on top of the hardship you were already enduring.
That's exactly right, which is why I've never really understood this. And sorry for my strong language there, but I mean, it doesn't make any sense. We're extending an olive branch. You're on unemployment, and now we're going to potentially create a tax crisis for you, which they're not too forgiving. I don't know if you've heard that. So here's the thing. It's also taxable to the states. Now, will states come in and give you some sort of relief and say, no, we're actually going to exempt it? We haven't heard that. I don't think so. States are in pretty bad shape. So if you're listening to this and you are thinking, well, oh, no, I was aware of this and I told them withhold taxes, they're withholding at 10%. And like Josh said, if you're not in the 10% tax bracket, you're still creating an IOU every single unemployment check you received. All right, what about these direct stimulus payments? Are those taxable?
No. You know, that is income that you received back in the spring. Maybe it seems like ancient history by now.
Some people still just received it.
Really?
Yeah. I heard from a client who said they just got theirs in September.
Wow.
Yeah.
Wow. So, you know, that $1,200 check, if you remember receiving yours, that's not going to be counted as income to you. In fact, technically, not to get too nerdy on this, but it's almost like a prepayment of a credit that's going to be landing on your tax return. So some of you maybe didn't get your check yet and could still be eligible for it here in 2020. You need to make sure, obviously, that you and your CPA are not letting that slip through the cracks.
No, I'm just telling you, in full and fair disclosure, we are pre-recording this. So at the moment you're listening to this, there might be another round of helicopter money that's out there. But for the CARES Act, $1,200, yeah, it's not taxable. It's not taxable. I know a lot of people just threw it in the bank and said, I'm gonna have to pay this back, or they're gonna take it back. I'm not spending it. And no, they're saying they're not taxing it. Now, the other thing that was in the CARES Act that they said we're not taxing it are these PPP loans, Paycheck Protection Program loans to small businesses, and they were a very, very interesting loan. because they are forgivable. I love those loans. But the thing is, they said that the forgiveness portion, that forgivable nature, when it's forgiven, that's not going to be taxable. Okay, great. I appreciate that. But then they've come out and said, yeah, but the money that you use this loan for, we're not going to let you expense it. AKA, it's still going to drop to your profit and still be taxable. We're waiting to see if they change that ruling, but it's very possible PPP dollars are taxable.
Well, and you're talking about really two different groups of people, because what Congress intended and the way that they wrote the law was that this would not be taxable income, because they were specifically thinking about the forgiveness of the loan. Normally in the past, if you have a loan forgiven, yeah, it's going to be taxable to you. But it's the IRS, in their interpretation of how they're going to enforce these laws, they're treating it as income for people. And it would take an act of Congress to clarify that for them at this point, it seems.
If your head is spinning after an hour of all of this, I don't blame you. But the real message is there are unbelievable tax opportunities that exist right now. Get comprehensive financial planning. Work with your CFP who's helping you with all 6 areas and helping you with tax planning. All right, that's all the time we have for today. On behalf of Josh, Kevin, myself, and all of us at KFG, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.